You roll up to a bank. You hand them your bread. They say thanks, no cap. Then they hit you with 0.01% interest per year. That's 10 cents on $1,000 per year. Dead ass. You bounce. You think you're Gucci. Meanwhile, that same bank is finna lend your $1,000 to somebody else for 6, 8, maybe 12%. And here's the tea nobody spills. They're out here doing this with money they technically don't even have yet. This ain't some conspiracy theory. This is just Tuesday. This is literally how it works. And once you peep the actual mechanics, not the watered-down high school version, the real version, you're never gonna look at banks the same way, frah. Bet. Let's get into it. Okay, start here. The most basic way a bank gets their bag is low-key embarrassingly simple. It's called the net interest margin, the spread. They borrow your money at a broke rate. They lend that same money to someone else at a way fatter rate. They pocket the difference. Cha-ching. Right now, the average savings account in America is out here paying around 0.4%. The average 30-year mortgage rate, around 7%. That gap, 6.5 points, is the spread. That's the whole engine. Everything else banks do is just a remix of that same energy. But hold up, because you might be thinking, okay, banks take in deposits and lend them out. Supply and demand. Simple enough. Except that's not really what's going down. Banks do not lend out your deposits. They straight up create new money when they make loans. That's not cap. That's literally how it works. This is the part of banking that is 100% real and sounds 100% made up. It's called fractional reserve banking. And it ain't new. Banks have been running this play for like several hundred years. Here's the TLDR. You drop $1,000 at Chase. Chase got to keep a slice on reserve, let's say 10%, so $100. The other 900, they can send it out the door. So they loan 900 to some other person. That person parks their 900 at a different bank. That bank keeps 90, loans out 810, and it just keeps going, no cap. Your OG $1,000 has now turned into, through this whole process, nearly $10,000 floating around in the economy. The Bank of England dropped a paper in 2014 called Money Creation in the Modern Economy. You can peep it. It literally says, and I'm paraphrasing, commercial banks create money by making loans. Not the central bank, the commercial banks. When JP Morgan approves your mortgage, they don't go dig up some old money from a vault and slide it to you. They type a number in a ledger. That number becomes real money. Your house gets funded by money that minutes ago literally did not exist. And they will charge you interest on it for 30 years. Sit with that for a sec. Now, the spread and money creation, that's the foundation. But modern banks aren't out here riding just one wave. They've built a whole empire of income streams on top of it. Let's run it down real quick. Fees, overdraft fees, maintenance fees, wire transfer fees, ATM fees, foreign transaction fees. In 2022, American banks collected roughly $8 billion in overdraft fees alone. $8 billion from people who had negative $47 in their account. It's giving predatory for real. Wealth management and investment services. This is where banks really scale up and start balling different. They take a percentage, typically 1 to 2% of assets under management. When you're managing tens of billions, 1% is a very comfortable vibe. Trading and capital markets. The big dogs, Goldman, Morgan Stanley, JP Morgan, are out here going crazy on trading securities, underwriting IPOs, advising on mergers. JP Morgan's investment banking division alone pulled in about $5.7 billion in 2023. not a drill. Credit cards. This one's elegant, though. Banks issue you a card, you spend your coins. The merchant pays the bank roughly 1.5 to 3% of every transaction just for the privilege of taking your payment. Then, if you carry a balance, you're on the hook for 20% interest on top of that. The bank gets paid twice by everyone in the room. It's actually wild when you think about it. And then there's insurance, real estate, foreign exchange, derivatives. The list goes on and on. Banks aren't just banks anymore. They're financial supermarkets, and every single aisle got a markup, bestie. Let's look at some actual numbers, because this is where the abstract hits different and gets personal. In 2023, J.P. Morgan Chase posted a net income of $49.5 billion. That's the most profitable year any bank has ever had in American history. That's not a typo. At the same time, the Federal Reserve had jacked interest rates to a 22-year high. Mortgages were pushing 8%. Credit card rates hit an all-time average of 21%. You might think high interest rates kinda clap back at banks too, right? They gotta pay depositors more. And here's the quiet irony. They low-key don't. When the Fed raised rates, banks immediately slapped those higher rates on borrowers. Your mortgage went up, your credit card rate went up, your car note went up. But the rate on your savings account, that crept up maybe 0.25%, maybe. Barely moved, no cap. The spread, that engine we talked about, actually got wider during the rate hike era. Banks were making more per loan while barely throwing depositors a bone. The gap between what they earn and what they pay out got bigger, fatter, juicier. This isn't illegal. It's not even surprising once you understand the structure. It's just the system doing exactly what it was built to do. Built by who, you might ask? That's a whole nother video, frah. Here's the thing about a system built on borrowed leverage and manufactured money. It needs vibes to function, not capital. Vibes. Confidence. If everyone with money in a bank tried to pull it all out at the same time, a bank run, the bank is cooked because the money ain't there. Most of it got lent out or invested somewhere else. This isn't a bug. This is the feature. In March of 2023, Silicon Valley Bank folded in 36 hours, not because they were doing anything extra reckless by banking standards. They had bought long-term government bonds, mad safe in theory. But when interest rates spiked, the value of those bonds tanked. And when a few big depositors started getting the ick and pulling their money, word spread fast, mostly on Twitter. Within a day and a half, it was stick a fork in it. Done. The 16th largest bank in the United States. Gone. Over a weekend. That's actually insane. That same month, First Republic Bank and Signature Bank also caught the L. The FDIC ended up taking over assets totaling over $500 billion. And yet, within weeks, the narrative had shifted to the banking system is sound. And it low-key is, mostly. The big banks are straight, well-capitalized, diversified, too big to be allowed to flop. Too big to fail is a phrase that entered the cultural chat after 2008. What it really means is, if this institution goes down, it takes too much other stuff with it. So the government's gonna swoop in. The losses get spread around to the people. The profits, though, those stay with the shareholders. The upside belongs to shareholders. The downside belongs to taxpayers. That asymmetry is literally baked into the architecture of the whole modern banking system. And that's on period. Zoom out for a second. Banks aren't the villains in this story. They do something genuinely important. They take fragmented capital, your savings, my savings, pension funds, corporate accounts, and channel it towards stuff that actually moves the needle. Mortgages that let people own homes, loans that let businesses hire people, credit that smooths out the rough patches in economic life. That's real. That matters. But the structure of how banks get their bag doing that, the money creation, the fee extraction, the asymmetry of who eats the risk, that structure shapes basically every financial decision made in this country. When housing becomes unaffordable, part of the reason is that cheap debt made prices go absolutely feral for decades. When credit card debt hits $1 trillion for the first time ever, which it did in 2023, part of the reason is that 20% revolving credit is a remarkably profitable product to push on people who are running low on funds. When you understand how banks get their bag, you start to understand why the world is built the way it is, where the incentives flow, what gets funded and what gets left on read. It doesn't make you a hater to see it clearly, it just makes you more clear-eyed. So, back to where we started. You roll up to a bank, you hand them your bread. They give you 10 cents on $1,000 per year. They loan it out at 7%. They cook up new money in the process. They tack on fees. They earn on your spending, your debt, your transactions. They've been running this play in some form for 300 years. And here's the question that doesn't have a clean answer. Is there a better system? Central bank digital currencies, decentralized finance, public banking models, credit unions that send the profits back to the members. These are all real alternatives being put in the chat by real economists and policymakers right now. Some of them might actually slap. Some of them might cook up whole new problems nobody's anticipated yet. What we do know is this: the current system didn't fall from the sky. It was built by people with specific goals in mind. And what gets built by people can get rebuilt. Or not. That part's on all of us.